Hey, what's going on, everybody? Happy April Fool's Day. I don't have a good April Fool's joke for you today, so sorry about that. But I wanted to jump in, give you a quick market update with everything that's going on. There's been a lot of volatility, a lot of news coming out, of course. So I wanted to shed some light on that, let you know what we're thinking, what's been going on with our portfolios, and then give you a couple tips on some things to be looking at here over the next few weeks. So jumping into the market action here. We have had a lot of tariff news. I actually saw there was a pretty good headline. Someone did a podcast I listened to, and it showed, it said that the markets have been terrifying, but they spelled terrifying with T-A-R. So I thought that was pretty creative. I was going to steal it from him. So anyways, what's been going on year to date? Things have gotten hit pretty hard. I threw Tesla in here. Of course, we're not invested in Tesla. A lot of our clients are not. However, it's a good just reflection to look at because over the last few years, everybody has been wanting to add Tesla, Nvidia, Microsoft, Google, Amazon, the Magnificent Seven exposure. Give me more tech. I want to get higher returns. We need to have more concentration in tech. Well, yeah, that's great while things are working, but when it's not, that's where it can get a little bit scary. So Tesla down 32% so far this year. The Russell 2000, our small cap index, smaller US companies, is down almost 10%. The NASDAQ, our tech-heavy index, is down almost 8% year-to-date in just 4 months. The S&P down about 4.5%. The Dow Jones is the best of the worst here, down about 1.5%. So these other two indexes here, we're not invested in these funds. This is not a recommendation to utilize these. I just wanted to give you an overall perception of what's been going on in the market and what we've been doing with our portfolio. So TLT is a long duration government bond fund. Now, again, bonds have been doing great this year. And we talked a lot about our long duration bond fund that we bought about 1.5 to 2 years ago, LGOV. The reason that we did that is to put a seatbelt over the portfolio for volatile times, right? We've had these discussions, and our long duration bond fund has performed fantastic. It's been pretty similar to TLT, and it's held the portfolios up perfectly. I mean, it's done exactly what it's supposed to do. Over the last few years, people might say, why would you want to invest in bonds? The US stock market has been doing fantastic. The S&P is 20% every single year. We don't want to have any bonds. Well, the reason that we add bonds to the portfolio is for times like this, for the volatile times when the S&P and the NASDAQ are, struggling and getting hit every single day. Our bond portfolio is performing great and holding the portfolio up. Another sector that's been doing very well, again, we're not in this exact index, and this is not a recommendation to buy it. However, the European stock market index is up about 8%. So that's another sector that has been doing extremely well in our portfolio, is our foreign market funds and our emerging market funds, everything outside of the US. So that's why we have exposure in those different sectors. That's why we don't go super heavy on tech, even though it's been doing great over the last few years, because it's not an if, it's a when sectors of the market are going to get hit. Like I've told you, tech cannot lead the market rally forever, every single year. Do I think tech will do great over the long run? Yes, I really do. And that's why we still do have tech exposure. We just don't want to be all in one single sector. So a couple things that have been happening. First off, one of the main reasons I think that the pullback is taking place, of course, tariffs, and we'll talk about that here in a second. But another one is during January, we were hitting new market high, new market high, new high, new high. Every single day that you woke up, there was a new market high. That's not sustainable. The market never goes up in just a linear fashion. We know that. There has to be pullbacks. It's actually a healthy thing for the market. We want there to be pullbacks over time. And again, we're prepared for them. That's why we diversify. But so that was one main thing. I think that everything was just overvalued. And then, of course, as the tariffs came in, it created a lot of uncertainty. Like we've talked about before, the market doesn't mind bad news. The stock market just does not like uncertainty. And right now, every single day with the tariffs has caused more uncertainty. We don't know, the news every day, it's telling us something different. So it's hard to have anything to actually bite your teeth into, because what's here today may be gone tomorrow. And that's just something that overall scares investors. So wanted to just, again, continue to shed some light on this here. Another screen will pop up. Okay, so while Trump hasn't yet disclosed details about his April 2nd tariff plans, the president said he plans to announce so-called reciprocal tariffs, which are designed to match the import duties We are seeing early signs of stagflation environment emerging, driven not by external shocks, but by deliberate policy. That combination is a toxic one for equities. Business and consumers are likely to experience rolling price increases for several quarters due to Trump's tariffs. So basically, right, everybody's worried that as these tariffs happen, US prices are going to continue to go up and up and up. And what have we been talking about for the last 3 years? Inflation. Post COVID, inflation has been the biggest topic going on in the stock market, basically. We've been looking at that 2% number forever, right? And that's when the Fed started to raise interest rates to help bring inflation back down. So now we're getting back to a point of, well, the Fed's been telling us they want to cut rates. The cutting rates has been kind of baked into market prices. We're expecting to get some rate cuts. Well, now all of a sudden, if tariffs continue to happen and inflation increases, what if the Fed cannot cut rates, or worse, what if they raise rates? That would be absolutely terrible for the market, right? So these are some of the worries that investors are feeling, and that's why we're getting this crazy roller coaster. I mean, you wake up in the morning, the NASDAQ and the S&P might be down 2%, and by the time that the market closes, it's up 0.5%. I mean, they're crazy, crazy swings. So yeah, there's just a lot of uncertainty. So, and of course, inflation remains elevated above the Fed's 2% target. We know that's been a super major concern. Tuesday's stock slump comes a day after the S&P 500 posted its worst quarterly performance in 2.5 years, shedding 4.6%. The heavy NASDAQ composite ended the first 3 months of the year with a 10% decline. So even if Trump's tariffs end up being less harsh than feared, the lack of clarity may already be leading U.S. household businesses to freeze their spending. So again, that's what it is. It's a lack of clarity. It's uncertainty. That's what's scaring everybody. So overall, what can we do about this? Of course, I cannot call President Trump and tell him to lay off on the tariffs. I cannot call Jerome Powell at the Federal Reserve and tell him to cut interest rates. You and I have no influence over those decisions. The only thing that we can do is control what we can control. So what can we do as investors? We can stay calm and patient, right? This little tiny blip of volatility has been 4 months. Now, I'm not saying it's over. You know, it's probably going to continue lasting here for the foreseeable future, for the next few months, or even throughout the end of this year. But that doesn't mean it has a crazy effect on your long-term goals. We have to keep our long-term goals in mind and stay patient. That's the number one thing. Number two, we're in tax season. We can control our tax efficiency using our Roth IRAs, looking at Roth conversions, looking at how we're going to withdraw from all these portfolios. We're talking about all these things, of course, in our semi-annual reviews, but making sure that we're efficient from a tax perspective, that's something that we can control. Number three, we can control your contribution rates. When you're in growth mode, we can control how much we're putting in every single month, how much you're saving. And for you guys that are in growth mode, these downturns are a blessing. You're buying the same exact positions at discounted prices. So when that money rebounds, it's going to perform exponentially even faster than your dollars that you invested at higher rates. So that's why we dollar cost average. That's why we contribute on a monthly basis, is to catch some of these downturns. So it's actually a good thing for longer term investors. And the last thing that we can control is just overall being diversified, right? Not panicking, not selling at the bottom. That's why we want to have exposure in the bond market, in emerging markets, in small cap, in large cap. We want to spread our money out so that we don't see these massive 30% declines with all of our portfolios. In our aggressive accounts right now with our diversified models, a lot of them are down, maybe 1 to 1.5%. That is so much easier to swallow than looking at your account and seeing a 10% loss and feeling that gut-wrenching panic of what am I going to do now? The other thing is, again, like I said, this is a 4-month session that we're looking at. You have to remember how your account has done over the long term. I mean, even just looking at the last 5 years, which is not even a long time, but 5 years from today, if you would have invested your money in these indexes, TLT, bonds have done relatively not great over the last, especially long duration bonds. When interest rates went up, long duration bonds got hit pretty hard. So long duration government bonds did pretty poor over that time frame, down 30%. But when we look at the Russell small cap index, up 75%, the European index up 90%, The Dow up 90%, S&P up 120% almost, NASDAQ up almost 150% over that time frame. Tesla was insane, 600% over the last 5 years. So over the last 5 years, you've made money. We can't just look and say, oh my gosh, I've lost so much money in the last 4 months. Yeah, I guess that's true. But again, you didn't actually lose it until you push the sell button and realize that loss. When we zoom out over a longer time frame and look at when your money started invested to where it's gone now, you have made money during that time frame. And that's what we have to keep in mind so that we don't go crazy wanting to try to sell at the perfect time and buy at the perfect bottom and start to timing all of these things. Stay diversified, stay patient, ride the wave, and keep your long-term goals in mind. And of course, that's something that I'm going to be helping with as we continue to get together for all of our reviews in the future. Okay, so getting away from just market-related action, a couple other things that I wanted to bring up really quick, some points that I found with a lot of clients that as we've been doing these reviews. So first one, check your beneficiaries on all of your accounts. I've made it a point during this round of reviews to show you exactly who your beneficiaries are and your contingent beneficiaries on all of your accounts that I am managing for you. I cannot change the beneficiaries for you on your 401ks and your bank accounts. So please go through and check those and make sure you have a primary and a contingent beneficiary that you want on all of those accounts. So God forbid something ever happened, none of that money goes into probate and the money goes exactly where you wanted it to go. So that's one big thing. Another big one that I found was reviewing your home and auto policies. Normally every quarter you're getting your premiums to pay those. So check your deductibles on those policies. A lot of times I find that clients have way too low of deductibles, maybe only $1,000 deductible. If you raise your deductible, your premiums will be lowered. Now, of course, we don't want to raise your deductible to $50,000. So if something happened, you have to come 50 grand out of pocket. But that's why we have, emergency reserves. That's why we hold excess cash to be able to pay for minor inconveniences. So raising I had one client raise his deductible from $1,000 to $5,000 on his homeowner policy, and it saved him about $1,000 a year in premiums. And that was just a small change to save, a good amount of money. So go through, check on your deductibles, call your insurance provider and just ask them, hey, if I raise it to 5 grand, 10 grand, whatever that may be, and whatever you feel comfortable with, what's that going to do to my premium? And, it should save you a lot of money. So at least something to just check into. Last thing too, the LPL conversion. Again, that's getting close here. Should be happening towards July. I just wanted to keep that top of mind because you're going to be getting a new online login. I will keep you updated when that actually takes place and when the accounts hit the new platform. You do not have to sign any paperwork. You're going to get a negative consent letter just outlining the transition that's taking place. So I wanted to give you a heads up for when that letter comes, you know exactly what it is and you're not worried because again, this is all planned. We're ready for this transition. I'm really excited for it. I honestly wish we could do it tomorrow. It's just there's so many advisors moving. Obviously, there's a lot of moving parts. So again, no paperwork needs to be signed. I'll keep you updated once the new online logins are created. Get that to all of you. Nothing's going to change from an investment standpoint, from how I'm managing accounts, how we're working together. All of that stays the exact same. Literally on your end, the only thing that's different is your paperwork will say LPL and you'll have a new online login. So that's everything that I have for you guys today. As always, please call me if you have any questions at all, want to chat about anything. I'm always available and happy to talk to you guys. So hope that you have a great April and I will be talking to everybody soon. Take care, guys. Bye.